let's talk about that and let's circle back. That segue is perfect because we're talking about investments and look, let's face it, ultimately you're talking about digitization of gold and that has helped people create wealth as well. And consumption has its place. But let's talk about investment in gold. You mentioned 10 to 15%, but there are multiple ways in which you can hold this digital gold. Sovereign gold bonds are not being issued as much nowadays for various reasons. But if you have the opportunity, should you buy it in the secondary market or should you go for an ETF? What are the advantages?
So the best form of investing into gold would be sovereign gold bonds. I mean,
if it's available.
So they're listed on the exchanges. So in fact, on the flip side, I mean, there could be an advantage to buy on the exchange because you may quote a lower price than the ongoing gold price. And if somebody is so desperate to sell, I mean, you may be the only buyer that he finds. So if the gold going prices are say 77,000, for example, you may just quote 75,000 and put a bid over there to say that, look, I'm willing to buy this particular series of SGB at a price of 75,000. I mean, if there's no other buyer and the seller is desperate for liquidity, the only option is for him is to sell it to you. So you could.
And a quick clarification, we'll talk about the taxability of all of this, but a clarification on this, if you buy the sovereign gold bond in the secondary market, and if, say, for example, you have 5 years of residual maturity, because these are 8-year bonds, and they become tax-free only after those 8 years, if you've held for the entire period, you can you can have a, what do you call
redemption,
it? Redemption after 5 years.
That's correct.
But then it becomes taxable. But what is the taxability if you buy it in the secondary market for the person who buys it?
So for individuals, okay, so first is if you're applying in the primary issue, like you make an application, you get the sovereign gold bonds in your account, and then you hold on till maturity. For individual, is tax exempt, as you rightly said. Now, hypothetically, I go to the secondary market and I'm acquiring the units, I'm acquiring the SGB from the stock exchange. It's a resale, somebody else is selling and I'm buying it. If I hold that till maturity also, and I redeem it at the time of maturity, that is tax-free for me again. Now, there is one area which there is not enough clarity, but however, because the Income Tax Act very clearly only states that if you're redeeming, not selling, okay, if you're redeeming your SGB, it is tax exempt.
Okay.
So which means that you don't need to necessarily hold on till maturity as well. Post 5 years, when RBI opens the window semi-annually to acquire back you can give your SGBs back, the units back to the RBI, it implies to say that even if that point in time you're redeeming, not necessarily till 8 years, but it could be in the 7th year or the 6th year for that matter.
Yeah.
Even then it is supposed to be tax exempt, but there is not enough clarity on this.
From what I have read, it's very clear in the way that it is described. When the product was launched, it was very clear. After 5 years, it becomes redeemable, but it's only tax exempt or capital gains is only exempt if you hold it for the 8-year period. That's pretty clear. But okay, let's talk about a couple more aspects and we'll get into the physical gold as well. But you were talking about if you can buy it in the secondary market, SGB is the best. Should you also consider looking at ETFs, and the taxation of that has also changed?
Correct. So there are other ways of owning it. So in case you're not comfortable with SGB, because again, the problem is that if you bought it and then you want to sell it again, and if you don't find a buyer, then again, you will have to give it a discount.
Liquidity is a problem.
Liquidity could be a discount, could be a problem because though they're listed on exchanges, there are not enough transactions happening. Sure. So that's why the price discovery mechanism is not as transparent. So there are other options available to you. One is that you go to a gold fund, like how you invest in gold mutual funds. I mean, any mutual fund for that matter. You could buy a gold fund. So that's like the day-end NAV. You will get the NAV and you buy and sell at that NAV. Sure. So you're not again, dependent on market forces for the price discovery. You have gold ETF as an option. So like you buy shares, you just simply go onto the exchange and buy the gold ETF, and that will come into your demat account. So again, when you're buying and selling, that will be dependent on the buying and selling bid that is being done on the stock exchanges. So yes, there are a couple of ways that you can own gold. It's not necessarily need to be in the physical form. Now, from a taxation standpoint, I mean, if you're investing into gold funds, then of course it's going to be the 2 years is a holding period. And if you're selling it before 2 years, whatever gains you make is going to be added into and you have to pay tax as per your tax slab. If it's more than 2 years, then it is 12.5%. The same thing for gold ETF, the holding period reduces to 1 year because it's a listed security. So gold ETF, your short-term capital gains will be for a holding period up to 1 year. And post 1 year, it is going to be 12.5%, the long-term capital gains.
And that's quite an interesting change. We will circle back to that in just a bit. But physical gold, it's mired in a lot of things that not necessarily are the best practices, of course, but then in ideal situation, when somebody comes to you and sells their gold, there is a record of it. Usually they're buying gold against gold, right? But there is a capital gains that is due there as well.
There is, of course, capital gains are applicable, as government also has announced in the last budget. But what's important is that the whole trading in gold, even if it's a coin or anything, like Harsh just mentioned about a discounting, which was 3.5% to 4% as a normal practice, I believe. In gold, that doesn't happen. If you would buy a slab of gold, you can walk down 3 jewelers and get the best price and walk home with the money. Obviously, it's official, it's transparent, and it's documented. It's needless to say, it depends as to how you transact end of the day, but that's the norm. So what you value that you get as a consumer, even for the 10 grams of gold that you actually sold on the floor, is very clear and transparent. When you feel you have the correct price for the entire product end of the day.
Do most people come into the store to buy gold against gold, or do they actually sell and take cash?
So there is a very small percentage which is for encashing, unless one has to purchase probably a property, or there's some severe situation in the family which is either health or financial. Then there's an encashment. But not out of fancy that I want to simply sell out my gold today and encash it and enjoy it. No, that doesn't happen in literal sense.
And then the percentage of people that buy bullion in the form of either gold or in a coin or bar?
So overall, you can say is around 10 to 12% of retail business which happens on investment products, which is coins and bullion and things like that. And again, moreover, on occasions like Dussehra and Diwali that we have is when people end up buying auspicious purchases, which if they don't know what they want to buy and they're skeptical about some element of design that they're not sure about today, they'll end up buying a gold coin and probably trade that back whenever they feel of buying a piece of jewelry.
Best practice here, and this is more or less rounding up the conversation because I think we've covered most of the bases. When you are selling physical gold, the onus of paying the capital gains is on you. I think to a certain extent, the government has been a little lenient on this front for quite a while. But things are changing. Annual income statement captures quite a bit that it didn't in the past, or the income tax department didn't in the past. What advice would you give to people when it comes to managing their tax aspect when they're buying and selling gold?
It's always better to disclose everything because, ultimately the peace of mind that you have, it doesn't compare with any money that you save by hiding or, evading taxes. So the best practices, if you ask me, it's just simply put everything on record because your data is getting captured.
And what's the tax treatment on physical gold?
It's the same. You need to hold for 2 years.
Yeah.
And if you sell before 2 years, then it is short-term capital gains and long-term is
slab rate.
12.5%. Slab rate is short-term capital gains and long-term is 12.5%. The holding period being 2 years.
Okay.
So, if you have to pay, say, 12.5% tax, I guess, it's a good price to pay for peace of mind. The kind of data that is being shared and, because Rajiv will concur that when you're transacting, if the value goes beyond 2 lakhs, right? If the value is beyond 2 lakhs, PAN becomes compulsory.
For purchase of jewelry. But on selling, the jeweler will even transact 20,000 rupees by check.
Yeah. So that's
all the more reason.
That's all the more reason.
Yeah.
So while you're purchasing, if you're buying something worth more than 2 lakhs, then PAN is compulsory. If you're selling, the jeweler is anyways going to give you back a check. So that's
exactly.
So it is going on record in any case.
Precisely.
So I guess the peace of mind that you get by paying that kind of tax, I don't think there's any monetary benefit that you can compare with the peace of mind and sleeping peacefully at night. So and the data is anyways getting captured. So why would you not want to disclose everything?